7. Taxation of life insurance and tax strategies. Life insurance was originally designed to help people manage the financial risks associated with death. However, Canadians are increasingly using life insurance as a wealth accumulation and preservation tool, often for the purpose of creating an estate. One of the reasons it is used in this manner is the potential tax benefits it can provide. To advise their clients appropriately, agents need to have a good understanding of the tax implications of owning a life insurance policy and disposing of it. This chapter focuses on the taxation of personally owned life insurance, as well as using life insurance to manage taxes that may arise upon death. The taxation of corporate-owned life insurance is covered in Chapter 8. The booklet entitled Life Insurance Taxation Principles is a prerequisite to understanding the product-specific aspects of taxation covered in this chapter. 7.1 Key Concepts. There are several concepts that are key to understanding how life insurance is taxed, including Black small square tax-free nature of the death benefit, Black small square policy dispositions, Black small square policy gains, Black small square adjusted cost basis, ACB. 7.1.1 Tax-free death benefit. The death benefit from a personally held life insurance policy is exempt from tax. This holds true regardless of how long the policy has been in place, or how much the policyholder has paid in premiums, or even the type of policy, term, permanent, group, mortgage, etc. While the potential to receive a death benefit should not be considered to be an investment, the fact that the death benefit is always paid out tax-free certainly makes it quite attractive. The original face amount. For example, if a universal life (UL) policy offers a level death benefit plus account value, the beneficiary will receive the original face amount plus the value of the investment account tax-free. $102,993 tax-free. However, if the policyholder receives any other benefits while the policy is in force, i.e., before the death of the life insured, it may have immediate tax consequences, as discussed below. 7.1.2 Policy dispositions. Whenever a policyholder disposes of an insurance policy, there may be tax consequences. An actual disposition occurs when the policyholder gives up all ownership rights to the policy, by selling or surrendering the policy. However, other events or transactions can result in a deemed disposition for tax purposes, which means the Income Tax Act treats the policyholder as if he had actually disposed of the property and received proceeds from that disposition, even though there is no transfer of ownership, in some cases, or actual proceeds. Common situations that could result in an actual or deemed disposition of an insurance policy include Black small square policyholder surrenders all or a part of the policy. Black small square policyholder withdraws cash from the policy. Black small square policyholder takes out a policy loan. Black small square participating policy pays out dividends. Black small square policy becomes non-exempt. Life Insurance Chapter 7, Taxation of Life Insurance and Tax Strategies 115. Example. Carl bought a $100,000 UL policy 6 years ago, naming his wife, Sarah, as the beneficiary. The policy provides for a death benefit equal to the initial coverage plus account value. To date, he has paid $9,250 in premiums, and the account value is $2,993. If Carl dies today, Sarah will receive a total of $102,993 tax-free. Tax-free. However, if the policyholder receives any other benefits while the policy is in force, i.e., before the death of the life insured, it may have immediate tax consequences, as discussed below. 7.1.2 Policy dispositions. Whenever a policyholder disposes of an insurance policy, there may be tax consequences. An actual disposition occurs when the policyholder gives up all ownership rights to the policy, by selling or surrendering the policy. However, other events or transactions can result in a deemed disposition for tax purposes, which means the Income Tax Act treats the policyholder as if he had actually disposed of the property and received proceeds from that disposition, even though there is no transfer of ownership, in some cases, or actual proceeds. Common situations that could result in an actual or deemed disposition of an insurance policy include Black small square policyholder surrenders all or a part of the policy. Black small square policyholder withdraws cash from the policy. Black small square policyholder takes out a policy loan. Black small square participating policy pays out dividends. Black small square policy becomes non-exempt. Black small square policyholder dies and is not the life insured, such that ownership of the policy is transferred to another party. Proceeds of disposition are any amount the policyholder receives, or is deemed to have received, as a result of a disposition. These dispositions are discussed later in this chapter. 7.1.3 Policy Gains. A policyholder may realize a policy gain upon the disposition of all or a portion of his interest in a life insurance policy and, if so, he will have to report 100% of that policy gain as income. A policy gain is calculated as follows. Policy gain equals proceeds of disposition, adjusted cost basis, ACB. 7.1.4 Adjusted cost basis, ACB. The adjusted cost basis, ACB, is the cost base of an insurance policy for tax purposes. 17 The ACB of an insurance policy generally changes over time, and the insurance company will usually provide the policyholder with this number when a taxable disposition occurs. However, it is important for agents to understand what factors can affect the ACB over the life of a policy, because it will impact how much tax the policyholder will pay when disposing of the policy. 7.1.4.1 Last acquired date. There are three ways to calculate a policy's ACB, depending on when the policy was last acquired. Last acquired means the latest of the following dates. Black small square when the policy was first purchased. Black small square when ownership of the policy was transferred to the current policyholder. Black small square when coverage under the policy was last modified or reinstated. The last acquired date is also an important factor when determining a policy's exempt or non-exempt status, as discussed later in the section Taxation of exempt versus non-exempt policies. For simplicity, policies can be categorized in three groups for tax purposes. 18. Black small square Group 1, G1, policies are those that were acquired prior to December 2, 1982 and that have not been transferred to another policyholder or been modified since that time. Black small square Group 2, G2, policies are those were acquired after December 1, 1982 but before January 1, 2017, or previously G1 policies that have lost their status. Black small square Group 3, G3, policies are those that were issued after December 31, 2016, or previously G2 policies that have lost their status. A G1 policy will lose its status and become a G2 policy if ownership is transferred to another policyholder or if coverage is modified. Because G1 policies provide some significant tax advantages, agents should be careful about changing this status. A G2 policy will lose its status and become a G3 policy if it is converted to another type of policy on or after January 1, 2017. For example, a term policy that was issued in 2015 but that is converted to a permanent policy in May 2021 will be a G3 policy from that point forward. A G2 policy can also lose its status and become a G3 policy if any coverage that requires medical underwriting is added to the policy after January 1, 2017. Some examples include increasing the amount of coverage, adding a term rider to the policy, or substituting the life insured under the policy. 7.1.4.2 G1 policies. The calculation of the ACB of G1 policies, sometimes referred to as grandfathered policies, is simply the cumulative premiums paid to date, less the cumulative dividends paid out of the policy. While 1982 was over 30 years ago, agents may still encounter active whole life or UL policies that were issued prior to December 2, 1982. The ACB calculated under the old method will generally be higher than the ACB calculated under the methods for G2 or G3 policies. Remember that a policy gain is calculated as proceeds of disposition, ACB, so a bigger ACB means a smaller policy gain, and thus a smaller tax liability for the policyholder. Other tax advantages for these grandfathered policies are covered in the section Taxation of exempt versus non-exempt policies. 7.1.4.3 G2 and G3 policies. For G2 and G3 policies, the key factors that determine a policy's ACB are the cumulative premiums less the net cost of pure insurance, NCPI. The NCPI is a measure of the pure mortality costs under the policy for a given year, and it reflects a combination of the net amount at risk, NAAR, and the mortality risk for the life insured. In the early years of a policy, the ACB of a policy increases because the NCPI is less than the premiums. However, as the life insured ages, his mortality risk increases to the point where the NCPI exceeds the premiums and the ACB of the policy decreases. Over time, the ACB can reduce to zero, but it can never be negative. Regulations to the Income Tax Act prescribe different methods of calculating both the NCPI and the NAAR for G2 and G3 policies. These regulations also prescribe the use of updated standardized mortality tables for G3 policies, reflecting increases in life expectancies. We aren't going to get into the specifics of these methods, but the general result of these changes is that the NCPI of a G3 policy tends to be lower during the early years of the policy, compared to a G2 policy. Given the same premiums or deposits, this in turn means that the ACB of a G3 policy will tend to grow faster in the early years of the policy, compared to a G2 policy. It will take longer for the ACB of a G3 policy to reach zero as the life insured ages. These differences become important when you recall that the policy gain upon the disposition of an individually owned life insurance policy is the difference between the proceeds and the ACB. The situation becomes more complex if policy dividends, policy withdrawals, or policy loans are involved, and further adjustments to the ACB are required, as summarized in Table 7.1. Table 7.1. Factors affecting a policy's adjusted cost basis, ACB. ACB equals cumulative premiums, including ratings, cumulative NCPI, plus or minus. Plus minus. Participating policy dividends used for paid-up additions or additional term insurance, or to repay a policy loan. Dividends paid out to the policyholder in cash. Policy loans interest paid on a policy loan, unless the interest is deductible as a business or investment expense. The amount of a policy loan taken against the cash surrender value, CSV, of the policy. See the section Taxation of Policy Loans for more information. Policy loan repayments. The amount of a policy loan repayment, to the extent it exceeds any policy gain reported as income when taking out the loan. See the section Repaying a Policy Loan for more information. NA. Withdrawals or partial surrenders. NA. A prorated portion of the ACB, depending on the size of the withdrawal or the percentage surrendered. See the section Taxation of Partial Surrender for more information. Policy gains included in income. Any policy gain the policyholder had to include in income as a result of a policy loan, withdrawal, or partial surrender. 7.2 Taxation of Policy Dividends. According to the Income Tax Act, the payment of policy dividends triggers a deemed disposition of an interest in the insurance policy. The proceeds of disposition are deemed to be the amount of the policy dividend, less any amount that was used to pay an eligible premium. As a result, the policy gain is calculated as follows. Policy gain equals policy dividend, amount used to pay an eligible premium, policy's ACB. In most cases where the premiums are directed to internal transactions, i.e., through a paid-up addition, PUA, or term insurance dividend payment option, or to repay a policy loan, the resulting proceeds of disposition will be zero, and thus there is no policy gain and no taxable income. Recall also that premiums paid by the policyholder increase the policy's ACB by the same amount, while dividends paid out to the policyholder in cash reduce the ACB. As a result, most policy dividends paid out to the policyholder end up being a tax-free return of premiums. However, for G2 policies, the premiums for the purpose of calculating the policy's ACB for tax purposes exclude amounts the policyholder paid for accidental death benefits, disability payments, ratings for substandard lives, the cost of conversion rights or guaranteed insurability benefits, or any other supplementary benefit. For G3 policies, the full premiums are added to the ACB as they are paid, but then the cost of insurance related to any of these non-death benefits is deducted from the ACB as they are charged to the policy. Thus, if a G2 or G3 policy includes these types of benefits and if policy dividends are actually paid out to the policyholder, then there is a possibility that a policy gain may arise. The calculation of that gain is beyond the scope of this course. 7.3 Taxation of a full surrender. A policyholder is said to fully surrender a life insurance policy when he cancels or terminates the policy, such that he has no further rights or obligations under that policy. A full surrender is considered to be a disposition for tax purposes. 7.3.1 Policy Gain Calculation. Recall that when a policyholder disposes of an insurance policy, he will realize a policy gain that is calculated as follows. Policy gain equals proceeds of disposition, adjusted cost basis, ACB. In the case of a full surrender, the proceeds of this disposition are equal to the cash surrender value, CSV, of the policy, less any outstanding policy loans, including interest, or unpaid premiums. Taxation of a partial surrender. A policyholder is said to have partially surrendered his policy if he reduces the coverage or withdraws part of the accumulating fund, as discussed below. 7.4.1 Reducing coverage. If the policyholder decides to reduce the amount of coverage, it is considered to be a disposition, so a policy gain can arise. For G2 policies, the policy gain on a partial surrender is calculated on a prorated basis, so the CSV and ACB used reflect the reduction in the coverage. 7.4.2 Policy withdrawals. A partial surrender may also refer to a withdrawal the policyholder makes from the accumulating fund of a UL policy, even if he does not reduce the coverage. To calculate the policy gain for G2 and G3 policies, the same prorated methodology is used as for a partial policy surrender. For a G2 policy, this would be calculated as follows. For a G3 policy, the calculation would be based on the policy's net cash value, i.e., the CSV less outstanding policy loans. Tax payable equals $7,500 times 35% equals $2,625. For G1 policies, no prorating is required. Withdrawals only result in a policy gain once cumulative withdrawals exceed the entire policy's ACB. 7.5 Taxation of policy loans. If the policyholder takes out a policy loan, the proceeds of disposition equal the amount of the loan, less any amount of that loan that is applied to pay a premium under the policy. In the case of an automatic premium loan, APL, the deemed proceeds are nil, because the full amount of the loan is used to pay the premiums. If the policyholder takes out a policy loan that is less than the adjusted cost basis, ACB, he will not have a policy gain, but the ACB will be reduced by the amount of the loan. She would not have to report a policy gain. If a policyholder takes out a policy loan that is greater than the policy's ACB, he will have a policy gain equal to the amount of the loan, minus the ACB. The ACB of the policy will be reduced to zero. 7.5.1 Repaying a policy loan. If a policyholder repays a policy loan, he will be able to deduct the repayment from his taxable income, up to the amount of the policy gain he had to report when he took out the loan. If he repays more than this amount, the excess will increase the policy's ACB. 7.5.2 Policy loan interest. When a policyholder takes out a policy loan, the insurance company will charge interest on that loan. If the policyholder invests the loan proceeds for the purpose of earning property or business income, then he can deduct the interest he pays on that loan from his taxable income. Property income includes dividends, rent and interest, but it excludes capital gains. If the loan is for personal purposes, example, to buy a car, or if it is invested with the sole intention of realizing capital gains only, the interest is not deductible. If the policyholder pays interest but cannot deduct it, then the ACB of the policy will increase by the amount of that interest. 7.6 Taxation of exempt versus non-exempt policies. An exempt life insurance policy is a permanent insurance policy that was either Black small square last acquired prior to December 2, 1982, i.e., AG1 policy. Black small square last acquired after December 1, 1982, i.e., AG2 or AG3 policy, and used by the policyholder primarily for insurance purposes, rather than investment purposes. A non-exempt policy is a policy that was last acquired after December 1, 1982, that fails to meet the exemption requirements set out by the Income Tax Act, discussed shortly. Non-exempt policies are subject to annual accrual taxation, which means that the policyholder must report the investment income earned within the policy as taxable income in the year it is earned. If an insurance policy is an exempt policy, the policy's investment account, i.e., often referred to as the accumulating fund, can grow on a tax-deferred or tax-free basis. Tax-deferred means the investment income is not taxable during the year it was earned, but it may be taxed later if there is a policy disposition prior to the death of the life insured. Example, if the policyholder makes a policy withdrawal or takes a policy loan. If the investment account is paid out upon death of the life insured as part of the death benefit, the accumulated investment income is paid out tax-free, meaning it is never subject to tax. This section explains. Black small square the conditions a G2 or G3 policy must meet to be classified as exempt. Black small square what happens if a policy becomes non-exempt. Black small square what can be done, if anything, to recover that exempt status. Policies last acquired prior to December 2, 1982, i.e., G1 policies, are always exempt. 7.6.1 Purpose of exempt test, insurance or investment. The exempt test applies two rules, maximum tax actuarial reserve, MTAR, and anti-dumping rules, designed to answer the question, is this policy really insurance, or is it more like an investment vehicle disguised as insurance? These rules prevent taxpayers from taking unfair advantage of the favorable tax treatment of investment income that may be provided within an insurance policy. A policy that emphasizes investment opportunities over insurance protection will break one or both of these rules and will thus fail the exempt test. G1 policies are not subject to the exempt test and are not subject to annual accrual taxation. 7.6.2 Maximum Tax Actuarial Reserve, MTAR, Rule. To maintain exempt status, the cash value of a policy's accumulating fund, i.e., investment account, cannot exceed the Maximum Tax Actuarial Reserve, MTAR, which is the projected cash value of the accumulating fund of an exempt test policy. An exempt test policy, ETP, is a hypothetical policy that serves as a benchmark. It has the same death benefit and the same life insured as the real policy, with the remaining parameters set by the Income Tax Act, as discussed shortly. Furthermore, the projected future values of the accumulating fund cannot exceed the projected MTAR at any time in the future, up until the date the life insured reaches a specified age, 85 for G2 policies and 90 for G3 policies. On the policy's issue date and on every policy anniversary thereafter, the insurance company must compare the current and projected cash values of the actual policy's accumulating fund with the MTAR of the ETP, and report the results to the Canada Revenue Agency, CRA. 7.6.2.18 Pay endowment at age 90 for G3 policies. For policies issued after December 31, 2016, i.e., G3 policies, the ETP is deemed to receive annual deposits over 8 years, and the deposits are large enough to ensure that the policy will endow at age 90. Essentially, it is a limited payment whole life policy, as discussed in Chapter 3. A policy endows when its cash surrender value, CSV, equals the policy's face amount. This is shown graphically in Diagram 7.1. Life Insurance Chapter 7, Taxation of Life Insurance and Tax Strategies 125. Diagram 7.1. Maximum Tax Actuarial Reserve, MTAR. In other words, the MTAR line of the ETP describes an accumulating fund that will grow to equal the death benefit by the time the life insured reaches age 90, based on fixed deposits for 8 years, and growth at an assumed interest rate, minus the cost of insurance. This rate should be 3.5% minimum. Adjustments are made if the policy was issued after age 65, but that is beyond the scope of this chapter. For G3 policies, when comparing the cash values of the actual policy to the ETP, the accumulating fund is calculated as the cash value determined without regard to surrender. If this value is less than the MTAR of the ETP, then the policy is exempt from annual accrual taxation. 7.6.2.220 Pay endowment at age 85 for G2 policies. For G2 policies, the ETP is deemed to receive annual deposits over 20 years, and the deposits are large enough to ensure that the policy will endow at age 85. In other words, for G2 policies, the MTAR line of the ETP describes an accumulating fund that will grow to equal the death benefit by the time the life insured reaches age 85, based on fixed deposits over 20 years and growth at an assumed interest rate of at least 4%, minus the cost of insurance. The impact of the changes implemented for G3 policies effective for January 1, 2017 will vary by insurance company, but in general the maximum deposits permitted for a G3 policy while still maintaining exempt status will be lower than the maximum deposits permitted for a G2 policy. 7.6.3 Maximum Tax Actuarial Reserve, MTAR, Remedies. While life insurance policies are initially designed to be exempt, it is possible for a policy to become non-exempt after issue, usually due to investment returns that were higher than expected. Fortunately, neither the policyholder nor the agent is responsible for applying or monitoring the results of the MTAR rule. Usually the terms of the life insurance contract specify that the insurance company is responsible for ensuring that the policy remains exempt. If the policy fails the MTAR test on its anniversary, the Income Tax Act allows a grace period of 60 days after that date for the problem to be fixed before the policy officially loses its exempt status. Once an exempt policy is declared to be non-exempt, i.e., if it cannot be restored during the 60-day grace period, it remains non-exempt forever. Most policies are designed to implement changes automatically if needed, using one or more of the methods discussed below. 7.6.3.1 Increasing the face amount. The death benefit can be increased by up to 8% per year. The death benefit of the ETP will increase by the same percentage, which will raise the MTAR line. Some universal life (UL) policies call for an automatic 8% increase in the death benefit every year, even if the policy does not fail the exempt test on the policy anniversary, because it increases the maximum amount that can be deposited to the policy. 7.6.3.2 Withdrawing premiums. The policyholder can make a withdrawal from the accumulating fund, which will reduce the policy's cash value. However, this may result in a policy gain if the withdrawal exceeds the prorated ACB, as discussed in an earlier section. Taxation of a partial surrender. 7.6.3.3 Side funds. Most policies include a provision whereby any excess amount will be moved from the accumulating fund into a taxable side fund, or shuttle account, to prevent the entire policy from becoming non-exempt. With a shuttle account, the funds will be moved back to the accumulating fund if and when the policy's accumulating fund is less than the MTAR line. 7.6.4 Anti-dump-in rule. A second rule, called the 250% rule or anti-dump-in rule, prevents the policyholder from making large lump sum deposits to the policy after its 7th anniversary. This rule applies to both G2 and G3 policies. 7.6.4.1 Applying the 250% rule. Beginning on the policy's 10th anniversary and every anniversary thereafter, the accumulating fund on that anniversary date is compared to the accumulating fund 3 years previous. So, the cash value on the 10th anniversary is compared to the cash value on the 7th anniversary, the cash value on the 11th anniversary is compared to the cash value on the 8th anniversary, and so on. If the value of the fund is 250% or more of the value of the fund 3 years prior, the anti-dump-in provision will apply. Example. On its 7th anniversary, Dean's policy had a cash value of $4,200. On its 10th anniversary, the policy had a cash value of $15,600. This is 371% of its value 3 years prior. Current cash value equals $15,600 divided by $4,200, x 100 equals 371%. Because this exceeds 250%, the anti-dump-in provision will apply. The anti-dump-in provision resets the date of the exempt test policy, ETP, to the 3rd preceding anniversary. The policy's cash value is then compared with the, usually lower, MTAR of the redated ETP, which will make it more prone to failing the exempt test, unless the remedial measures mentioned earlier can be applied, i.e., increasing the death benefit, withdrawing cash from the accumulating fund, or moving it to a taxable side account. Life Insurance Chapter 7, Taxation of Life Insurance and Tax Strategies 128. 7.6.4.2 Implications for minimum funded policies. The anti-dumping rule can be problematic for UL policies that have been minimum funded in the early years, which is a common occurrence, particularly for young families who intend to increase their deposits as their incomes increase and/or their expenses decrease. When a policy is minimum funded in the early years, the policy's cash values remain relatively low. If the policyholder later makes large deposits, this could easily result in a substantial increase in the policy's cash value, which in turn could trigger the application of the anti-dumping rule and increase the potential for the policy losing its exempt status. However, beginning January 1, 2017, a relief measure was introduced to relax the 250% rule somewhat for underendowed policies. This new provision allows the accumulating fund of the policy to grow by more than 250% over the 3-year period specified by the test if the value of the accumulating fund of the actual policy is less than 15% of the value of the ETP's accumulating fund for G2 policies or 37.5% of the ETP's accumulating fund for G3 policies. 7.6.5 If a policy becomes non-exempt. It is very rare for a policy to fail the exempt test because of the safeguards built into the policy and MTAR remedies discussed earlier. However, it still does happen upon occasion, and the consequences can be quite severe. Some of the situations that have the potential to make a policy fail the exempt test include black small square paid-up additions, PUAs, because they have a high ratio of cash value relative to the amount of coverage they provide. Black small square better investment returns than expected. Black small square extra deposits to participating policies. Black small square extra deposits to the policy. 7.6.5.1 Deemed disposition. If a policy becomes non-exempt, it is considered to be a policy disposition for tax purposes. This means that the policyholder will incur a policy gain equal to its cash surrender value, CSV, minus its adjusted cost basis, ACB. Note that Northwest actual disposition takes place, the policyholder has not surrendered the policy and does not actually receive the CSV, but he will still have a policy gain that will be taxed at his marginal tax rate. 7.6.5.2 Annual accrual rules. If a policy becomes non-exempt, the policyholder will have to report the income earned within the investment account on an annual basis. 7.7 Tax implications of replacing an existing policy. In relatively rare circumstances, a policyholder may decide to replace an existing insurance policy with a new one. There are many issues the agent must consider when recommending or assisting with a replacement, as discussed in the module Ethics and Professional Practice. This section deals specifically with the tax implications of policy replacement. 7.7.1 Policy disposition. Replacing a life insurance policy involves first putting the new life insurance in place, and then canceling the existing policy. This cancellation is a policy disposition, so it will result in a policy gain to the extent that the policy's CSV exceeds its ACB. 7.7.2 Tax advantages of older policies. G1 policies have extra tax advantages that are not available to newer policies, so this should be carefully considered before replacing an older policy. As discussed earlier in the section G1 policies, the ACB was calculated simply as cumulative premiums paid to date, dividends paid out of the policy. The ACB calculated under this older method will generally be higher than the ACB calculated on a newer policy, so the disposition of a G1 policy will likely result in a lower policy gain. In addition, G1 policies are not subject to exempt testing, and they are not subject to annual accrual taxation, so they can potentially accumulate larger cash values. Replacing a G2 policy with a G3 policy could also have tax implications. 7.8 Absolute assignments. A policyholder can usually transfer ownership, control, and rights under a life insurance policy to another person. This is called an absolute assignment. Absolute assignments can occur with or without compensation. The tax consequences of an absolute assignment depend on who receives ownership and how the transfer was accomplished. This section discusses the general rule, as well as special situations including absolute assignments too. Black small square a non-arm's length party, other than the policyholder's spouse or child. Black small square the policyholder's spouse. Black small square the policyholder's child or grandchild. 7.8.1 General Rule. As a general rule, if a policyholder absolutely assigns his life insurance policy to an arm's length party, his proceeds are deemed to be the amount he received in compensation, i.e., the transfer price, and his policy gain will be equal to the transfer price minus the policy's adjusted cost basis, ACB, immediately prior to the transfer. The transferee acquires the policy with an ACB equal to the transfer price. Two people are said to be dealing at arm's length if they are unrelated and they complete a transaction by acting entirely in their own independent economic interests. Very few absolute life insurance assignments are actually done at arm's length, and one of the following situations is more likely to apply. 7.8.2 To a non-arm's length party. Exceptions to the general rule apply if the absolute assignment occurs via one of the following situations, regardless of the amount, if any, that the policyholder received in compensation. Black small square the transfer is via gift or bequest. Black small square the transfer is from a corporation. Black small square the transfer is a result of the operation of law, example, transfer to a successor owner or a joint owner with right of survivorship. Black small square the transfer is to any other non-arm's length party. A non-arm's length relationship is deemed to exist between relatives, or any two unrelated parties who have a common interest and do not carry out a transaction in a way that two complete strangers might. If any of the above situations apply, then the proceeds of disposition are deemed to be equal to the amount that the policyholder would have received if he had fully surrendered the policy, unless the spousal or child rollover rules apply, as discussed shortly in sections assigning a policy to a spouse and assigning a policy to a child. Usually this means the cash surrender value less any outstanding policy loans. The person who acquires the policy acquires it with an ACB equal to this same amount. This keeps the policyholder from avoiding a policy gain by giving the policy away, or selling it to someone else at a discount to its true value. 7.8.3 Assigning a policy to a spouse. The Income Tax Act allows property to roll over from one spouse to another, meaning that it can be transferred without triggering a taxable disposition. This rollover applies to all types of property, including life insurance. So, if a policyholder assigns ownership of a life insurance policy to his spouse, he is deemed to have acquired proceeds equal to his ACB, and his spouse is deemed to have received the policy with the same ACB. This applies even if the recipient spouse paid the transferor spouse for the policy. 7.8.3.1 Opting out of the spousal rollover. The spousal rollover is automatic. However, the transferring spouse can choose to opt out of the rollover by filing a special election with his tax return. A policyholder might want to opt out of the rollover if he has a lower marginal tax rate than his spouse, or if he has income losses that he can use to absorb the resulting policy gain, example, rental or partnership losses. Point 19 By opting out of the rollover, the ACB for the recipient spouse will be higher, which in turn will reduce the policy gain when the recipient spouse later disposes of the policy. When a taxpayer gives or sells property to his spouse, any property income, example, interest income, dividends or rents, or capital gains she earns on that property is generally 20 subject to income attribution as long as the taxpayer is still alive. This means that the income will be taxable to the transferor spouse even if it is earned and legally belongs to the recipient spouse. Once the transferor spouse dies, the income attribution rules cease to apply. 7.8.4 Assigning a policy to a child. The Income Tax Act also allows a policyholder to roll over an insurance policy to a child, if all of the following conditions apply. Black small square the transfer is done for no consideration, i.e., the child didn't pay the policyholder for the policy. Black small square the life insured by the policy is the child, or that child's child. The rollover will not apply if the policyholder is transferring a policy to his child and the policyholder is the life insured under that policy. Any Policy gain that is subsequently triggered when the transferee child disposes of the policy will be taxable to that child, as long as the child is at least 18 years old by the end of the year. If the child is under 18, the income attribution rules will apply and the policy gain will be taxable to the original policyholder. Ownership of a policy cannot be transferred to a child until the child is at least old enough to enter into a contract, generally age 16, but this may vary by province. 7.8.4.1 Defining child. For the purpose of this rollover provision, a child of the policyholder includes the policyholder's child, grandchild, or great-grandchild, regardless of whether that relationship is by blood or adoption. It also includes any other person who, at any time prior to reaching the age of 19, was in the care and custody of the policyholder and was wholly dependent on the policyholder for support, example, a niece who is under the policyholder's guardianship after the death of her parents. 7.8.4.2 Direct transfers only. The rollover to a child can only occur if the policy is transferred directly to the child. If the policy is transferred to a trust that benefits the child, the rollover will not apply. 7.8.4.3 Education funding or other intergenerational transfers. The rollover of an insurance policy to a child provides some interesting opportunities for intergenerational wealth transfer. For example, a policyholder could acquire a UL policy on the life of a child, and maximum fund it to build up the CSV as quickly as possible. He could then give the policy to that child, and the rollover would apply. Once the child is 18 years of age, the child could surrender the policy, and the policy gain would be taxable in that child's hands, often when the child has little or no other taxable income. However, if the child surrenders the policy prior to age 18, income attribution rules would apply, meaning that the original policyholder would have to report the policy gain as income. Note that this tax strategy tends to be more effective when the transfer skips a generation, and when the life insured is not a minor. This is because the amount of money that can be accumulated within an exempt policy is partially a function of the age of the life insured and the face amount. The younger the life insured and the lower the face amount, the lower the MTAR line on the exempt test policy. 7.9 Death of the policyholder. If the policyholder dies and he is not the life insured by that policy, then generally he is deemed to have disposed of that policy immediately prior to death. For tax purposes, death is treated much like an absolute assignment. Under the default rules, the deemed disposition upon death will result in a policy gain on the policyholder's final tax return, equal to the policy's CSV minus its ACB. 7.9.1 Rollover to spouse. The rollover discussed in the section assigning a policy to a spouse also applies to policy transfers upon death. 7.9.2 Contingent policyholder. A policyholder is allowed to designate a contingent or successor policyholder on his life insurance policy, who will automatically receive ownership of the policy upon his death. This not only makes it clear who is to receive the policy, it allows the policy to bypass the estate, so the transfer is done quickly and is not subject to probate fees. However, designating a contingent policyholder will not allow the policyholder to avoid the deemed disposition rules upon death, unless a rollover applies. 7.9.2.1 Rollover to a child. As noted earlier in the section assigning a policy to a child, a policy can also roll over to the policyholder's child, provided that the life insured by the policy is the child or the child's child, but only if the transfer is made directly. The transfer cannot be done via a trust or estate. If the policyholder wants to take advantage of the child rollover provision upon death, he should name the child as the successor owner. As successor owner, the child will automatically receive ownership of the policy upon the policyholder's death. 7.10 Taxation of life insurance strategies. The previous sections have examined how life insurance is taxed from a product perspective. This section explores the tax implications of various strategies that can be implemented using insurance, including black small square using the policy for collateral, including borrowing for business use. Black small square annuitizing the cash surrender value to create a steady income. Black small square leveraging a life insurance policy to create a retirement income. Black small square charitable giving. 7.10.1 Using the policy as collateral. Rather than taking out a policy loan, a policyholder may also be able to use the policy's cash value as collateral for a loan from a third party. Basically, the policyholder assigns the rights to the policy's cash values and death benefit to the lender, which is called a collateral assignment. If the policyholder defaults on the debt, the lender can surrender the policy and use the cash surrender value to cover the debt. If the policyholder dies before repaying the loan, the lender can recover the debt either from the death benefit, if the policyholder was the life insured, or by surrendering the policy, if the policyholder was not the life insured. The main advantages of taking a third-party loan secured by a collateral assignment of life insurance, as opposed to a policy loan, are: Black small square. Unlike an absolute assignment, a collateral assignment is not a deemed disposition for tax purposes, so it will not trigger a policy gain. Black small square. The full cash value stays in the policy, where it can continue to grow on a tax-sheltered basis. 7.10.1.1 Borrowing for business use. When borrowing money for business purposes, the lender may require security in the form of a collateral assignment of life insurance. This could apply to term or permanent insurance. 7.10.1.2 Deducting premiums. If the business loan is secured by a collateral assignment, some or all of the premiums will be deductible, as long as the following conditions are met. Black small square. The loan is from an authorized lender. Black small square. The lender requires a collateral assignment of an existing or new policy to secure the loan. The amount that is deductible is limited to the lesser of the net cost of pure insurance, NCPI, and the premiums actually paid. If the coverage exceeds the amount of the loan, the premium deduction is prorated accordingly. 7.10.2 Annuitizing the cash surrender value, CSV. A policyholder can create an income stream by annuitizing the CSV of his policy, which means using the CSV to buy an annuity that will provide an ongoing series of income payments, either for life or for a fixed period of time. By annuitizing the CSV, he is essentially canceling the contract and surrendering the policy. As a result, he will generally realize a policy gain to the extent that the policy's CSV exceeds its ACB. Policy gain equals $430,000 to $290,000 equals $140,000. 7.10.2.1 If the policyholder is disabled. Some tax relief is provided if the policyholder is totally and permanently disabled at the time he annuitizes the CSV. If this is the case, the policy gain will be spread out over the life of the annuity. This will ease the burden on the policyholder's cash flow for the year of annuitization, and may also result in the policy gain being taxed at a lower rate because his marginal tax rate over the annuitization period will likely be lower. 7.10.2.2 Partial surrender. Policyholders in retirement may realize that they no longer need as much life insurance as they did when they were younger, but they do not want to give up their life insurance protection entirely. They may choose to decrease their coverage and annuitize only a portion of a policy's CSV. This will be treated as a partial surrender for tax purposes, with a prorated policy gain as discussed earlier in this chapter. 7.10.3 Leveraging a life insurance policy. Retired policyholders looking for a tax-free source of retirement income may be able to leverage their existing life insurance policy in what is often called an insured retirement strategy. 7.10.3.1 Collateralizing the cash surrender value, CSV. Recall that a policyholder may be able to use the CSV of his life insurance policy as collateral for a loan, and that doing so does not trigger a deemed disposition. Under an insured retirement strategy, the policyholder negotiates a series of annual loans, where each loan is secured by the policy's CSV. When the life insured dies, the lender recovers the amount of the cumulative loans from the death benefit, with the remainder going to the beneficiaries. This is called collateralizing the CSV. The policyholder gets a tax-free payment from the lender, which can be particularly important to those in retirement who are trying to minimize their net income to avoid clawbacks of old age security, OAS, benefits. The cash value remains in the policy where it can continue to grow on a tax-sheltered basis. This growth in the accumulating fund will help extend the duration of the income stream, because the lender will not let the cumulative loans exceed a certain percentage of the CSV. 7.10.3.2 Interest paid or capitalized. Depending on the lender, the policyholder may have to pay the interest on the loans annually, or the lender may allow the interest to be capitalized, meaning it will be added to the cumulative loan balance outstanding, which is payable at death. Both methods have their drawbacks. Interest that has to be paid annually will reduce the policyholder's retirement cash flow. Interest that is capitalized will reduce the policy's estate value. 7.10.4 Charitable giving. There are a number of ways that a person can use life insurance to help meet his philanthropic goals, including Black Small Square assigning a new life insurance policy to a charity. Black Small Square assigning an existing life insurance policy to a charity, or Black Small Square naming a charity as the beneficiary of a new or existing life insurance policy. Each of these methods has the potential to result in a charitable donations tax credit. The following sections explain how the charitable donations tax credit works and how it applies when using life insurance for a charitable purpose. 7.10.4.1 Charitable donations tax credit. A person who makes one or more donations to a registered charity can claim non-refundable federal and provincial charitable donations tax credits for the amount of those donations. The tax credit rates are stepped. For most taxpayers, a federal credit rate of 15% is applied to the first $200 of donations claimed during the year, and a federal credit rate of 29% is applied to donations over $200.22. The provincial credit rates vary by jurisdiction. The tax credit is non-refundable, which means that the donator can only use the tax credit to offset his income tax otherwise owing, but he cannot use it to generate a refund. However, he can carry unused credits forward for up to 5 years, and use it to reduce his tax liability in one or more of those years. In addition to the fact that the charitable donations tax credit is non-refundable, there is a limit on the amount of donations that can be claimed for the year. This limit is normally set at 75% of net income. Net income includes all forms of taxable income, minus deductions for things such as Registered Retirement Savings Plan, RRSP, contributions, child care, and moving expenses. When the donor dies, the limit is increased to 100% of net income for the year of death, and the immediately preceding year, because there is no opportunity to carry any unclaimed amounts to future years. This limit is an important consideration when making a large donation using life insurance. 7.10.4.2 Assigning a new insurance policy to a charity. A policyholder can acquire new life insurance coverage, on his own life or on someone else's, and then give or assign that new policy to a registered charity, provided the charity is willing and able to take over ownership of the policy. Because a new life insurance policy does not yet have a cash surrender value, the assignment of the policy is not considered to be an immediate charitable donation, and the charity cannot issue a tax credit to the donor. However, if the policyholder continues to pay the premiums on a life insurance policy after assigning it to the charity, the amount of those premiums would be eligible for the charitable donations tax credit. This applies regardless of whether the policy is for term or permanent life insurance. 7.10.4.3 Assigning an existing insurance policy to a charity. A policyholder can also assign an existing insurance policy to a charity, provided the charity is willing and able to take over ownership of the policy. If the existing policy is a permanent insurance policy, the charity will issue a tax receipt to the policyholder equal to the CSV or the fair market value of the policy at the time of the assignment. This is because once the charity takes ownership, it can choose to surrender the policy, and will receive the CSV in cash. Existing term policy to a charity will not result in a tax receipt. An absolute policy assignment is a deemed disposition for tax purposes, even when it takes the form of a charitable gift. As a result, assigning an existing life insurance policy will result in a policy gain to the extent that the policy's CSV exceeds its ACB at the time of the assignment. This policy gain will be taxable at the donor's marginal tax rate. If he continues to pay the premiums for that policy after the assignment, he will be able to claim the charitable donations tax credit on those premiums. 7.10.4.4 Naming a charity as the beneficiary. A policyholder can also name a charity as the beneficiary of a policy. The policyholder will not get a tax receipt at the time he names the charity as the beneficiary, nor will he get a tax receipt for the premiums he pays, because the charity does not get ownership or control of the policy, and they cannot surrender the policy to receive the cash surrender value. There is no guarantee that the policyholder will not change the beneficiary at a later date, unless the beneficiary designation is made irrevocable. There is no guarantee that the policyholder will continue to pay the premiums and keep the policy in force. If he lets the policy lapse, the charity will not receive anything upon his death. Instead, the charity will issue a tax receipt to the policyholder for the amount of the death benefit paid out upon the death of the life insured. If the policyholder is also the life insured, the executor of the policyholder's estate, or liquidator of the succession, can allocate the available donation on the basis of the estate taxation year when the donation was made, a taxation year prior to the estate settlement, and the policyholder's last 2 taxation years to obtain a tax credit. Managing taxes upon death. Life insurance is often used to manage or pay for the taxes that become due as a result of death. While life insurance cannot help the policyholder or life insured avoid these taxes, it can provide the funds to pay them, and thereby preserve the estate for the intended beneficiaries. The 4 primary taxes or fees that can burden an estate include: tax on capital gains. Tax resulting from the collapsing of registered plans, RRSP, RRIF, etc. Taxes payable by the estate. Probate fees. Agents must estimate these liabilities with sufficient accuracy to determine if the estate will be large enough to cover them, or if insurance is required. Candidates are reminded to review the booklet entitled Life Insurance Taxation Principles to ensure they are familiar with these tax principles. Chapter 8: Business Life Insurance. Competency components. Analyze the available products that meet the client's needs. Assess the client's needs and situation. Competency subcomponents. Analyze the types of contracts that meet the client's needs. Articulate the client's needs based on the risks that could affect his financial situation. Life Insurance. Chapter 8: Business Life Insurance. 146.